Bringing in Mihir Vora, Director and Chief Investment Officer at Max Life Insurance. He's joining us right now on the show. Mihir, thanks very much for taking out the time. Sentiment seems to be changing a wee bit, but too soon to jump on the bandwagon and start buying heavily?
Hi, good morning. Yes, sentiment does seem to be a little bit positive. We saw FII numbers positive after a long time yesterday. So that's something to be happy about. On the global macro front, I would say the oil price fall in the last couple of days is definitely a positive for India. Because as we know, we do import a lot of oil and it impacts inflation, currency, everything. So that's one positive. But overall, looking at the global growth prospects as well as the domestic growth prospects, economically, I think the global and local economies are a bit of a muddle-through zone. Having said that, from the market's point of view, the kind of negativity that we've seen in the past 18 months probably has discounted a lot of those concerns. And if we believe that markets typically lead the economy by about 1 or 2 quarters, then probably in the bombed out segments, stocks, sectors, there may be good value already out there.
Okay. When you're talking about bombed out segments, are you referring to autos, real estate? There is some excitement around something that could come about. Metals have just about started picking up. Infra as a pocket in anticipation of what could come about with regards to the government spending, and some conversation about front-loading in, infrastructure expenses by the government. Would these sectors be primarily on your radar?
Yes, definitely, because we are not really expecting any kind of pickup in private sector capital expenditure. That can take quite some time to pick up. But what is immediately possible is the segments that you mentioned. There could be initiatives towards housing, real estate, auto, consumer finance, etc., which can probably help the economy in the short term. Because the long-term fixes are, of course, required, but they will take some time to pan out. But in the meantime, whatever fiscal leeway that the government has probably can and will be used in these pockets.
Good morning, Neeraj here. You of course weigh in a bit on some of these factors or high frequency conversations that happen around autos. You reckon that it is this millennial demand which could be hampering, or do you believe that there's a temporary lull which will come back in terms of demand for autos?
Look, the millennial debate is probably a bit overdone. I mean, even if there was an impact, it can't happen overnight, or it can't happen in the last in a few months suddenly. That would have panned out over a period of time. So my guess is the bigger factor is still the availability of finance, the fact that a lot of NBFCs and banks have withdrawn financing to consumers as well as to dealers. Those are more of the factors which could create these kind of sharp turns. The demographic trends, etc., take much longer to pan out. So I think that debate is a bit maybe overdone.
Okay, so let's try and talk about pockets which are cyclical in nature, and if you believe that it's okay to try and bet on these stocks, even if you on the basis of how you are trying to time these cycles. Are you buying into the non-ferrous space? The valuations are still not as comfortable as the ferrous names compared to historical averages. There is some resolution, some positive talk between US and China. Are these telltale signs of going out and buying into these names?
So yes, there is good value in this space. In fact, the ferrous as well as non-ferrous metal space. But these are segments which we really don't own as core holdings. We kind of are, more of tactical trading opportunities that we look at. Because global commodities typically move in super cycles, and at this point in time, there is no commodity super cycle or there is no trend that tells us that the global economy will do well for the next 3 to 4 years. So to that extent, because there is deep value in these segments, we would tend to be more of tactical allocation approach. We would tend to take more of a tactical allocation approach rather than a strategic approach at this point in time.
No, a point well taken, Mihir, but not from a perspective of whether you would do that or not, but just trying to understand, when the cycle turns, I think the prices won't remain. Would you think it would be would you think it would be an unwise move to try and do some allocation out here with the belief that the cycle may be turning, or is it difficult to call that right now?
So there is value, and we've seen that when there is deep value, you do get 20-30% moves quite rapidly. So if one wants to play for that, and given the little bit of hope on US-China relationships panning out, and the fact that China is again talking about fresh stimulus measures, it could be a tactical call, yes.
Would you be a big buyer, in some of the stocks where there has been, from the broader market space obviously, where there has been a correction in terms of valuations, but the business model still seems to be strong, and because probably the surrounding environment and the rest of the mid caps and the small caps are getting beaten out, these kind of stocks also sort of rode the wave down?
Yes, so for example, in some of the banking stocks, even in the private banking space, we have seen a certain amount of de-rating happening in names where there were certain corporate exposures, etc. But the fact that these are still private sector banks and they can take the corrective measures fast enough can offer good opportunities because they have been beaten down with the rest of the pack. Those kind of opportunities are definitely there. Even in the auto space, we have seen some of the good quality large names also being hammered down by almost 40, 50, 60% even in the auto ancillary space. But we continue to believe that these are names which don't which will not lose their globally competitive position that they have built over the past many years. So we would treat these as more of cyclical opportunities rather than structural de-rating stories. So there is definitely value in these good quality names across sectors.
One last question, and this is a common thought process, that in a market like this, it is the pure play FMCG stocks where you get your essentials from, where the spending is not going to go down, because you will end up spending on all your essentials. In light of that, would you still bet big despite the discomfort on valuations, despite what most of these stocks have done in the past, to go and invest freely?
So if we are talking about the markets picking up from here and the economy picking up in the next 3 to 6 months, then the valuations in the FMCG segments have already been overdone, because people have been hiding in these pockets for quite some time. Over the last 12 to 15 months, even though some of the good FMCG names have not given that great numbers in terms of volume growth, markets have still flocked around these names for the safety of it. So if one wants to play for a turn in the market, then this would not be the segment to go. If one believes that markets are really very uncertain and still there is some downside left, then probably this would be a place to hide, not otherwise.
Okay, Mihir, so good having you. Thanks much for taking the time out and speaking to us today and giving us your thoughts. Appreciate it.